Good afternoon, everybody. This is Ben Tomczyk at the Committee for a Responsible Federal Budget. Want to thank you for joining us this afternoon. About 2 weeks ago, many of you may have seen that we had a poll on our Twitter feed asking what you would like the topic of the next webinar to be. And we heard from more than 700 of you with the topic, well, with the winner being today's topic, buy our debt. Now, joining us today to help you is my colleague, Mark Wine, who's the Senior Vice President and Senior Policy Director at the committee. Before I turn it over to Mark, just want to give folks a few housekeeping items. For starters, we are recording this webinar. In addition to that, if you do have questions throughout the webinar, please feel free to send them using the chat feature at the bottom of your screen, and we will get to them as soon as Mark is done presenting. And with that, I'd like to turn it over to Mark. Mark, thanks for joining us.
Sure, thank you everyone for being here. Please bear with me for a minute while we figure out the technology, and hopefully we won't cut out this time, but no promises. Appreciate everyone joining today, and I think this is a really important topic we're talking about, but also want to make sure you all know that we're going to be doing these, continuing to do these webinars regularly. I think they're a really valuable resource, and we're getting a lot of interest. So if your topic in the survey wasn't picked, it may be in the future, and we're going to be doing more solicitation, trying to answer all the questions you might have about the current state of our economy, about the current state of our budget, and about the state of play in Congress. For now, I think I want to talk about a question that really we've been asked over and over and over again, which is who is going to buy all the newly issued debt that's occurring as a result of the current crisis? Let me start by offering some context. So I think most everyone knows at this point, we are currently in the midst of an economic crisis that at least has never been this deep since the Great Depression. Hopefully it will be short-lived. Hopefully, because this is so public health driven, when things reopen, the economy will recover quickly. But right now, we're something like 15% unemployment and rising. A lot of people are either furloughed from their jobs or have been permanently separated from their jobs. And there's a lot of businesses that are threatening to become insolvent, to run out of money and have to shut down. This is a precarious economic situation on top of what's truly a public health crisis. And as such, the federal government has stepped in, I think, in some important ways. We may disagree on some of the details, or some might, but it's pretty universally understood that the federal government was going to need to step in here to address this crisis, to help to stabilize the economy, to make sure that folks have enough money to make it week to week. And they have relatively aggressively so far. Just through legislative action, Congress has already authorized what will ultimately be about $2.5 trillion more of debt. They've authorized about $3.5 trillion of new spending, loans, and tax breaks, some of which will be recovered. And they've already dispersed about $1.5 trillion of that. That's not even accounting for the actions undertaken by the Federal Reserve or by the executive branch. So we are spending a lot. This is just legislation already enacted. And when you combine what we're spending with the reduction in the GDP, reduction in the size of the economy, and the fact that due to this crisis, the federal government is collecting a lot less tax revenue, what you get is a debt bomb. What you really get is a debt explosion. We entered this year with debt at about 80% the size of the economy. Both we and the Congressional Budget Office have estimated it will exceed the size of the economy by the end of this year, and will exceed its previous record set in World War II as soon as next year, and certainly within a few years of that. So we have record high levels of debt. And not surprising, these are caused by unprecedented deficits. If you remember back to the Great Recession, that was the last time we had unprecedented deficits. The budget deficit hit $1.4 trillion. And at the time, that was enormous, but it pales in comparison to the $3.7 trillion we are projected to run in deficits this year. In other words, the deficit is likely to quadruple between last year and this year. And while it will then come down next year and the year after, it won't come down that rapidly. In fact, we estimate that just this year and next year, the federal government's likely to issue over $6 trillion of debt, 6 trillion. And that assumes no more legislative packages. And it assumes not necessarily a V-shaped recovery, but a relatively robust and quick economic recovery. So with all this borrowing, it really begs the question, how are we actually going to get someone to pay for this debt? Who's going to buy the debt? Just to look at this another way, April of last year, the federal government ran the equivalent of a $12 billion surplus. We actually reduced our debt by $12 billion. That was a lot because tax payments come in April. But even if you look at a more normal month, like say February of this year or November of last year, deficits we were running were in the 100 to 200 billion per month. In the month of April, the federal government increased its debt by $1.4 trillion, right? So remember that record I said for an entire year, 1.4 trillion in 2009? That's how much we borrowed just in the month of April. And to borrow, we need somebody willing to buy the debt. When the federal government runs a deficit, they need to go to markets and they need to say to the market, can somebody lend us the money? Can somebody buy our bonds so we can use it to spend? When the government expands its deficits, that money can come of really one of 4 places. Either people save more in order to buy the debt. In other words, money that was going to spend on consumables or otherwise being put in the economy is instead used to buy more government bonds. Number 2, people and businesses and investors may reallocate their assets. They might buy more government bonds by buying less stock or less corporate bonds, or putting less money into money market accounts, which is sort of like short-term business lending. So they can reallocate their assets. Possibility number 3 is we could be getting the money from abroad. Foreign governments, central banks, and even private foreigners, individuals and companies could buy US debt. Or by the way, side note, they could buy other US assets. That makes it easier for domestic purchase of debt. Or option number 4, the Federal Reserve can buy our debt. Now, before we understand who's buying this new debt, it helps to understand who typically buys our debt, who owns our debt. The latest month for which we have detailed data on who owns our debt is September of 2019. It feels like ages ago, but that's actually only about 6 months ago, 8 months ago, something like that. Feels like time has no meaning now that we're all locked in our homes, but it wasn't that long ago. Now, back in September of 2019, about almost half of our debt was owned domestically by either state and local governments, in mutual funds or other investment instruments, by banks, or by pensions, individuals, businesses, other investments. So about almost half the debt, 47%, was owned domestically by actors other than the federal government. About 40% was owned by foreign governments. By far, the largest part of that, about $1 trillion each, was Japan and China. The next largest country, the UK, owns about 300 billion. So other countries really pale in comparison. And then about 13% of the debt was owned by the Federal Reserve back in September of 2019. That's actually pretty high by historic standards. Typically, the Federal Reserve has owned half a trillion to $1 trillion of the debt. But since the Great Recession, they dramatically increased their debt holdings, and they own 13% of our debt in 2019. Now, as we look over time, unfortunately, the data on the domestic holdings isn't as clear, but we know that the overall picture hasn't changed much. The debt expanded a bit between September and December, and a bit more between December and February. Japan bought a bit more of our debt. The Federal Reserve bought a bit more debt, but you can see the overall picture has generally stayed the same. This is all before the crisis really took effect. Now turn to the end of April, so about a week ago. We now no longer have data separating foreign and domestic holdings, but you can see by comparing April to February, they're about the same. The increased net purchases from either foreigners or domestic has not increased much since February and April. The entirety really of the debt increase can be explained by an increase in debt purchases from the Federal Reserve. And in fact, if you map this over time, what you'll see is that essentially starting the beginning of March, and especially the middle of March, the Federal Reserve really started ramping up its bond purchases. A couple weeks later, the government really started ramping up its debt sales. And so while a little bit in advance, if you look at this graph, what you can see is that essentially the Federal Reserve has on net, bought roughly all of our new debt. All of the money we've borrowed since the beginning of March has essentially been bought by the Federal Reserve. Now, you notice I use words like essentially and on net. That's really important. The Federal Reserve does not buy debt directly from the federal government. The government is not allowed to say, we're going to borrow and we're just going to have the Federal Reserve finance it. Instead, what happens is the federal government still has to auction its debt to those other actors that I talked about, to banks and dealers that ultimately get it, to mutual funds, to foreign governments, to all these other places. But at the same time the Treasury is issuing debt, the Federal Reserve is buying debt from those private actors. And so even though the Federal Reserve isn't buying debt directly from the Treasury, they're effectively ensuring that the amount of debt outside of the Federal Reserve is staying constant. And by the way, you'll notice they're not even actually buying the same kinds of debt. Most of the debt, the vast majority of the debt the federal government has issued since this crisis started is short-term bills. That means debt that is bonds and things that last less than a year. Often these are just 1 month bonds or 3-month bonds. They're short-term bonds. The Federal Reserve is buying some of those, but to a much greater degree, the Federal Reserve is buying what we call notes. They're buying longer-term debt that's 1 to 10 years, and even debt that's 10 to 30 years. And so while on net, the Federal Reserve is buying the Treasury's debt, they're not actually buying the same debt the Treasury is selling. The Treasury is mainly selling short-term debt, while the Federal Reserve is mainly buying long-term debt. So there's this meme out here that I think, if any of you know what a meme is, it's sort of like a dumb cartoon that's shared on Twitter and Facebook. But there's this meme that I'm sharing here called, haha, money printer go burr. And you can see it's dollar bills going through a printer. For some reason, they're already printed before they go through the printer. So I won't deconstruct the cartoon itself too much. But the idea here is the federal government is essentially printing money. That's the idea here, is the federal government should be printing lots and lots and lots of money. And an important question is that what we're doing? We know we're not directly doing that. You know, we're not doing it in the way that countries have historically, where the Treasury is printing money. But if the Treasury is borrowing and the Federal Reserve is essentially creating new money, is that just the same as if we're monetizing the debt, if we're printing the money? The answer to that question isn't simple. First of all, I think it's important to understand the context in which the Federal Reserve is buying the debt. The Federal Reserve has essentially announced they will buy as much debt as necessary to keep the market stable. That's not quite the same as saying they will buy as much debt as is necessary to fund the federal government, although it's maybe not too different. But they are buying this debt at the same time they're also dramatically expanding their purchase of mortgage-backed securities. And at the same time that they're greatly ramping up their loans. They're buying more municipal bonds. They're buying state and local debt. They're indirectly buying corporate debt. They're buying loans from banks. Overall, they're dramatically expanding their balance sheet, partially for what's called quantitative easing, where essentially they want to replace illiquid assets with liquid assets like cash, and partially is an effort to stabilize the overall economy. And so one argument here is, yes, the federal government's borrowing $2 trillion, and yes, the Federal Reserve is buying $2 trillion, but it's just a coincidence. The Federal Reserve is buying $2 trillion to stabilize the economy. The Treasury is borrowing $2 trillion also to stabilize the economy, and these have nothing to do with each other. I think it's a little naive, but there's definitely something to that. This is the Federal Reserve would probably be doing this quantitative easing to some degree, whether or not the Treasury was borrowing a lot. It's also important to understand where the money is coming from. Overall, the Fed has not really increased its currency issuance very much. If you look at it, kind of the currency is growing as the population grows, as the demand for money goes, sort of a steady increase in the M1 money supply. That has not really changed. What has changed here is that the Federal Reserve is dramatically increasing its reserve deposits. And what this basically means is that the Federal Reserve will go to a bank, to a primary dealer, and say, we're going to buy your bonds. And in exchange, the account that you have with us at the Federal Reserve, we're going to say there's more money in that account. So they essentially are printing digital money, but it's not money that can directly be used by the bank. It's money the bank can leverage in order to make loans. And the idea of quantitative easing is to encourage more of that lending, to encourage more of an expansion of the money supply through the banks, not through direct purchases of currency. So you could say, ordinary times, expending reserve deposits is different from printing money because reserve deposits have an interest rate. When the interest rate is 0, you could argue expanding reserve deposits is a form of digitally printing money. And so in that case, this is sort of monetization, or it's at least very close to monetization. But then kind of, an economist says on the one hand, on the other hand, it's a rat of cans. It's really important to look at this again in the overall context. The typical way through which the Federal Reserve undertakes its operations is with a focus of getting the interest rate down as low as possible, or down as low as is necessary. The interest rate is zero, and so the Federal Reserve does not have that option. And so while yes, in some sense, they are creating new money, and yes, in some sense, that is associated with more debt, as I said before, the Federal Reserve is also undertaking this quantitative easing effort to try to provide liquidity to the economy. And it's impossible to say the extent to which this printing would happen otherwise, and to the extent which we're really monetizing our debt versus more traditional quantitative easing. Lastly, I'll just point out that the Federal Reserve is not alone here. Most of the world's major central banks are also, quote unquote, printing money. They're also expanding their balancing sheets. They're also buying other debt. And I should also say the US government is not the only kind of debt the Fed is buying. As mentioned before, they're buying state and local debt. They're buying corporate debt. They're buying lots of other types of debt. Another important question is, even if the Federal Reserve has bought all of our debt to date, will that continue? Maybe, maybe not. The federal government so far has borrowed about $1.5 trillion. They're likely to borrow $2 trillion more just over the rest of the fiscal year, just over the next five months. It's not clear the Federal Reserve is going to buy all that. When they started this operation, they were buying $75 per day in treasuries and really ramping up. Now they're buying $7 a day. So, excuse me, $7 billion a day. More than $7, but a lot less than $75 billion. At $7 billion a day, they would not nearly be able to keep up with the new debt issuance. And so even if the Federal Reserve had bought the first bit of our COVID debt, it's not clear, at least under their current strategy, they're going to continue buying our debt. And so to some degree, we probably are going to start counting on the rest of the market, on savers in the economy, on mutual funds, on foreign governments, and on other sources to buy our debt going forward. And to the extent we do, we need to worry about things like China threatening not to reduce its debt holdings, and there not being enough demand for treasuries because we don't have any way to deal with our long-term fiscal situation. This isn't an argument for trying to discontinue support for the economy or anything like that, but it is an argument for being careful as we think about spending infinite amount of dollars, and to instead target these dollars on where they're needed, understanding that as important as debt issuance is, it's not free. It has a cost. And even when the Fed buys it, eventually as they unwind that balance sheet, we are going to face the penalty on the other side. So at this point, I've hopefully either answered your questions or confused you more. And Ben, we can turn it over to see what other questions there might be.
Thanks so much, Mark. I want to go back. You had a slide early on in your presentation showing the breakdown between who owns our debt, foreign and domestic. And one of the most frequent online questions we got when folks were registering was, what happens if these countries decide to dump our debt all of a sudden? What happens if China or Japan just decides to get rid of it? And then on top of that, let me also ask, we received a question during your presentation as well. Will there ever come a day when foreign countries don't want to buy US debt?
These are both great questions. So first of all, let me tell you some sort of good news. There's only 2 countries in the world that really own enough of our debt that by themselves, they might be able to have an impact. Countries could collude together, but there's really only 2 countries that own enough debt that by themselves could have an impact, and that's China and Japan. China and Japan each own more than $1 trillion of our debt. That's pretty substantial. Given that we're headed towards $20 trillion debt, even if they hold that, that means that together they'll still own 10% of our debt. They'll each own 5%. That's substantial. That's not enough that they really have full control. But if one of those 2 countries decided to sell off debt, that could reverberate into the market. That could scare away other investors, first of all. Secondly, we don't know how deep the treasury markets are going to be coming the other side of this. And so it may push up interest rates and cause other types of destabilization. The good news for now, we think, is it's not necessarily in even China's interest to sell our debt. It hurts their economy more than it hurts our economy for them to get rid of all of our debt because they're counting on it for economic stability. Now, they may be playing the long game. They may not be. They may be using it as a leverage tool. They may not be as worried about their short-term economy. And so we can't just count on everybody thinking rationally, right? We can't count on the deterrence strategy like we do with nuclear weapons that it's definitely going to work. It may not. And so we should be worried about having too much debt and being too reliant on foreign countries for that debt. But the good news is for now, even with these threats, it seems like they're going to hold on to it. And probably for the most part, foreigners will hold on to our debt so long as A, we're the world's reserve currency, B, we have a strong economy relative to the rest of the world, and C, we show that we have a functioning political system. And related, D, we show that our fiscal policy, if not sustainable, could be made sustainable. If any of these things start to break, it becomes that there's clear that there's a point of no return where our fiscal policy can no longer be made sustainable. Our debt to GDP is just on too high a track, cannot be reversed. It's clear our political system is completely broken. Other countries emerge as possibly blended reserve currencies as a replacement to us. If these things start to happen, we could see foreigners' demand for US debt start to fall. And then we'd have to count on domestic buyers, and that's not necessarily a good bet for us.
Thanks, Mark. Just want to remind folks, if you have a question, please feel free to submit it at the bottom of your screen using the chat feature. A couple of questions coming in about the Federal Reserve, and I'm going to combine two of them. The first is, how long can the Federal Reserve keep doing what it's doing? And what are the implications of the Fed as it continues to monetize debt?
Yeah. So people argue over what is and isn't monetization, which was the idea I was getting at. I think among a lot of economists, we sort of consider it monetization when what the Fed is doing is buying treasuries in excess to what they would be trying to do to meet their various inflation and employment targets. And if they're doing that, if they're buying more debt than would make sense to strictly meet their inflation and employment targets or their stabilization targets, then what you risk is at first inflation and eventually possibly rapid uncontrollable inflation. And we've seen this in other countries. If the goal of the central bank or if the goal of the money printer is simply to finance your debt, other targets be darned, you can get into some really bad situations. We're not seeing that so far. What we've seen is generally a credible Federal Reserve and responsible Federal Reserve that doesn't always make the exact perfect choices, but does appear to be conscientious of these targets. And so as long as we're seeing inflation, below 2%, below 2.5%, I'm not overly worried, in part because I have faith that the Federal Reserve is going to know when to reverse course. If we start counting on the Fed as the future financier of all of our debts, we're going to be in big trouble and we will eventually face inflation. That's not a now problem, but it could become a future problem. And so we should think of this as a one-time stopgap, not as a permanent new way of living, because it won't work over the long term.
Mark, we had a question you about that the Committee for a Responsible Federal Budget is projecting that the federal government will be issuing, I think you said $6 trillion worth of new debt between now and the end of 2021. We had one person write in and say, how much of that is the result of spending to deal with the current health emergency versus non-health emergency spending?
Great question. So if you go to our website, or our new website, covidmoneytracker.org, or if you go to our current website, crfb.org, we have a really good breakdown. It's a bit out of date, but the story hasn't changed much, that tries to explain these deficit breakdowns. But I'm going to give you round numbers. We're projecting that over the next 2 years, 2020, 2021, there will be about $6 trillion of new debt. Of that, about $2 trillion existed prior to this crisis. This is mainly the result of fiscally irresponsible action over the last 5 years. The last 5 years, when the economy was strong, policymakers should have been doing what every other country did and trying to get our fiscal house in order, trying to reduce the debt, prepare for the aging of the population, things like that. Instead, we passed a spending increase for doctors. Then we did tax cuts. Then we did more bigger tax cuts. Then we did Bipartisan Budget Act, more spending increases, and we topped it off with more tax cuts. So we passed over a 10-year period, we passed about $5 trillion in new debt. And so I'm diverging a little bit, but 2 trillion of that 6 trillion was already here, largely because we've decided to act fiscally irresponsibly over the last 5 years. Another 1 trillion is essentially the direct result of the crisis on the economy, right? Because so many people are out of work, they're not paying payroll and income taxes, and businesses are not going to end up paying much in taxes either because they're not going to have much profit. And so those and other factors are about worth another trillion. The remaining half, the remaining 3 trillion, that's due to legislation. That's due to the CARES Act and to other pieces of legislation designed to rescue the current economy, to stabilize the current economy, to provide relief, and to spend on the public health situation itself.
And just in case anybody missed it, the website Mark mentioned is covidmoneytracker.org. And we will be sending a link out to that along with this PowerPoint presentation tomorrow after the webinar is done. Mark, we got a question regarding domestic holdings. And if a majority of our debt is held by domestic holdings, what is the threat of either a devaluation of our currency or massive inflation?
What threat would it create, or what is the, well, I'll try to answer that. Because in some ways, having your debt owned both domestically and foreigners is an important hedge, because it means that you're not too vulnerable from any one action. When you have domestic holdings, there's this loophole where you can sort of tax your way. You know, you can tax the debt holders to pay for the debt. When you have foreign holdings, that offers you some other hedges, but this also comes with more risks. It comes with the risk that when we try to devalue our debt, we can only do so in a way by also essentially devaluing our currency. And the result of that could be really problematic on trade balances, and in the worst case, could cause a global financial crisis, because so much of US debt is held around the world as a kind of a backbone to global financial system. And so I'm not predicting that will happen, but if we were, a disadvantage to us owning all the currency, the fact that we don't own it all domestically means we can't really inflate our way out of our debt without it reverberating into other international consequences.
We had another online questioner write in how during the Second World War, war bonds were issued to help cover the cost. Can we not do something similar to help deal with COVID-19?
So I think this is a great idea. I'll first say, there's no reason at this point to think that we need COVID bonds, in the sense that during World War II, there was a feeling that these war bonds are sort of a soft form of what we call financial repression. The hardest form of financial repression is you basically say to people, we're forcing you to buy bonds, and that's how you borrow your debt. The war bonds is a really soft version of that, because they're just it's like the Jewish guilt version of financial repression. You're saying, sure, if you don't want to support the war effort, you don't have to buy bonds, but I'm really disappointed in you, right? And so during World War II, we used this as a tool to actually sell our debt for cheaper. We don't need this now because we're actually still getting a great interest rate on our debt. For one, the Federal Reserve is buying a lot and providing stability to the market, but also we have certainly not seen demand from other holders declining. Maybe it's not rising as fast, but it's certainly not declining. And with interest rates where they are, there's no reason to think we'd have to offer a special kind of debt in order to get people to buy it. With that said, I think it would actually be advantageous to issue COVID debt, not because we need it, but because it would allow us to compartmentalize this and understand that this is a special one-time emergency borrowing that we are going to have to pay back, but we can do so over a very extended period of time. And so I like the idea of trying to compartmentalize the debt that's specific to this situation. And then once we get out of this crisis, or once we've at least gotten far enough into this crisis that we know we can see the other side, we can start coming up with a strategy to pay back the COVID debt. And again, it doesn't have to be over 5 years or over 10 years or even over 20 years. This is a massive crisis, and it's going to take time to finance. But if we issue and compartmentalize the debt today, we can figure out how to pay it back over time in a way that I think everybody would understand and would view as a fair intergenerational transfer.
Thanks. I want to go back. You had a slide regarding the types of debt the Fed is buying, long-term versus short-term. And we had someone write in and ask, are there certain implications for why the Fed would want to buy one versus the other? And what are they?
So this gets a little complicated into yield curves, but the basic idea here um, is the federal government is trying to even out the interest rate across the maturity period. The Federal Reserve is, and the interest rate on near-term debts are already zero. Like, I mean, if you want to go try to buy a 1-month bond, I think it's offering a 0.01% interest rate right now. It's effectively zero. And so there's just not much more the Federal Reserve can actually do there to affect the interest rate. And so while actually ordinarily the Federal Reserve plays mostly in the short-term space, once they've run out of room to affect the short-term interest rate, then they start playing in the medium-term space. And once they've run out of room to affect that, then they might start playing more in the long-term space. That's essentially what the Federal Reserve is trying to do. Meanwhile, what the Treasury is trying to do, I think, is just get the money quickly. And there's a much deeper market for people that basically just want to park their money for a short period of time while they see what happens in the market than there is for people that want to make a 30-year investment in the federal government at a 1% return or 1.5% return, which is effectively what we're offering right now.
So keeping on to that, we've actually had a couple questions about this. Following 2008, 2009, the Fed tried to unwind. What happens now? Where does the Fed go now, especially given that this may be a crisis that has to play out over the next year till we get a vaccine?
Yeah. So the Fed has already slowed its Treasury purchase, and it's now less focused on giving money to the federal government directly to issue its debt, and is more focused on stabilizing the rest of the economy. And so the Fed, both on its own and in coordination with the Treasury, has actually created a number of new facilities to lend money to cities and states and small businesses and large businesses and buy up toxic assets and other kinds of loans. And they're really going to expand their balance sheet just in an effort to stabilize the economy in any ways they can. Their goal here is to provide liquidity, to keep balance sheet safe, and to get us to the other side of this thing. Once we do have a vaccine, once we are on the other side, the Federal Reserve is going to have some tough choices ahead. They probably won't at that point be ready to unwind, but they probably step one for them would be to slow down on the emergency stuff, right? Slow down the things that are really outside of their own wheelhouse, the municipal lending, the corporate lending, things like that. They'll probably do that first. Then they're going to need to figure out at what pace they want to slow down the quantitative easing, because I imagine they're still going to probably be expanding their balance sheet to provide liquidity to the economy as we recover. It's not going to be that there's a vaccine in April and in May the economy's back to where it is. In the best case scenario, this recovery is going to take a couple of years. Depending on how much damage is done to businesses that are shut down, to people that are long-term unemployed, we could be talking about a 5 or 10-year recovery. And so the Fed is not going to turn off the spigot overnight, but they will first have to slow it down, and then at some point they're going to figure out how to reverse it. And how fast they have to do all that probably depends on what's going on with inflation and inflation expectations. Because a key part of the Fed's mandate is price stability. As long as inflation is really low, they can put almost all of their focus into economic stability, into employment, into the financial sector. Once inflation, and if inflation starts to spike, then the Fed starts to get worried and needs to figure out how to unwind us.
Carrying on with that, with the theme of the Fed, 2 questions. One, someone wrote in is, where does the Fed get their money to do this? And second, when we talk about domestic borrowing, doesn't that just mean that the citizens of the United States are on the hook for the bill? And if so, what happens when that bill comes due?
So these are 2 great questions. Let me start with the domestic borrowing. When we say domestic borrowing, essentially what we're saying is that the federal government is taking loans from US citizens. So it's generally in pension funds or mutual funds, but let me just give you a specific example. I can go to treasury.gov and I can buy a savings bond, right? And that savings bond pays me an interest rate. And essentially what I've done is I've loaned money to the federal government. I'm not on the hook for that. I actually have an asset. My asset is the federal government's promising to pay me money. Who's on the hook for that is the government itself. Now, where does the government get its money? Really, it has two choices. It either gets its money from taxing people in the future, or it gets its money by issuing yet further debt. And to the extent, we already start with the government that taxes and spending, you can also get its money by spending less. And so at some point, yes, the federal government's either going to have to pay the interest or pay the principal or both. And that means that who's on the hook for it is future taxpayers, future recipients of government programs, and possibly future borrowers and future earners. They're all going to have to pay back me from the savings bond that I bought. And so they are on the hook for this. This is the fact that we need to borrow to get out of this crisis does not make borrowing free. Borrowing has a cost. It is worth the cost because we are in a crisis, but we need to accept that it has a cost, and all of us that are earning in the future will have to pay that cost to stabilize the present. In terms of where the Fed gets its money, you can see it does actually, the Fed can literally expand currency, and it usually does that to match demand for money, to match sort of economic or population growth. But mostly it creates it through something called reserve deposits. And the idea here is essentially this. All banks have an account with the Federal Reserve where they put their reserves, where they sort of deposit their money. And the basic rule of thumb for a bank is for every $1 they have deposited with the Federal Reserve, they can lend $10 to other people, to other businesses, okay? So when the Federal Reserve wants to increase that lending, essentially what they do is they look at a bank's account with them and they say, okay, we see you have $100 with us. We're just going to change that 100 to 110. And so now pretend you got $110 with us, go lend accordingly. And so in that sense, they're sort of creating digital money, but that money never actually goes to the bank. It's just used by the bank as a starting point to decide how much the bank is able to loan.
Mark, let me ask you this. Can you talk about, we're talking a lot about who's buying our debt, who owns our debt. Can you talk about sort of where we see the debt going in terms of projections? And if it does go down, is it simply because the economy gets rolling again? Or, are there other factors we're not considering?
About my last worry in the world right now is that the debt is going to go down. I'll just show you, we've done 5-year projections, but you can extrapolate them with your mind and see where we're headed. The debt is likely to expand dramatically this year. And it's likely to expand somewhat next year, assuming a very robust recovery where the economy is sort of mostly recovered by the end of 2021 and fully recovered by the end of 2025. Assuming that, the debt will keep growing, but at a relatively slow pace relative to the economy. That's not because the debt is growing slowly. It's because the economy is going to be growing quickly during that recovery period. During a recovery period, you grow faster than normally because you're catching up. And so it's going to make it seem like the debt is growing more slowly. Once we've recovered, or once we've decided that we're not, if we don't recover, or if we recover very slowly, what you're going to see if you kind of look past this graph is the debt rising rapidly again. Not this rapidly, not like a big spike, but the debt rising 2-3% of a GDP per year. And we haven't done long-term projections yet per se, but I wouldn't be surprised if debt is twice the size of the economy by 2050. And that's under current law. That assumes that we don't pass more stimulus and more economic recovery measures. It assumes we let the tax cuts expire mostly at the end of 2025. It assumes that we don't have big Green New Deals or other huge new spending or tax cuts. It assumes a lot of things that aren't consistent with how policymakers act. And so we're really in a situation that our debt is likely to keep rising rapidly over the long term. And there's no plan at this point to get it under control. And that's really unfortunate and is going to be economically costly over the long term. It's going to ultimately mean slower wage growth, more of our federal spending focused on interest instead of all the things that we actually need, higher interest rates in the economy, and possibly the risk of a fiscal crisis on the horizon.
Well, Mark, I want to be respectful of everyone's time. So first off, let me say thank you so much for joining us this afternoon. Thank you to everyone who voted. We actually had, as Mark referenced, we had a Twitter poll. We had over 700 people vote. So we were excited to hear from all of you. We will be sending these slides out, and we will also be posting this webinar to our Facebook feed. We hope you will consider sharing it with your friends and with your family. And on behalf of everyone here at the committee, we want to say thank you for joining us this afternoon. Please stay safe and stay well. Thank you so much.